$1.15 trillion. That's the sum of infrastructure commitments OpenAI has signed in the last 6 months alone. Not projections, not aspirations. Actual contractual obligations binding the company to spending requirements that dwarf most national budgets. And here's what should concern you. The company reporting these obligations generated approximately $20 billion in annual revenue as of late 2025. The mathematics don't just look problematic. They represent something far more significant than a single company overextending itself. What we're witnessing is the formation of a closed-loop financial architecture where corporate investments flow in circles, where revenue exists primarily on ledgers rather than in bank accounts, and where the collapse of any single participant could trigger cascading failures across the entire artificial intelligence sector. This isn't speculation. These are verifiable transactions, public agreements, and mathematical realities that anyone can examine. By the time we reach the end of this analysis, you'll understand not just what's happening, but why the system is structured this way, who benefits from maintaining these arrangements, and what happens when the underlying assumptions prove unsustainable. The question isn't whether this system will face a reckoning. The question is whether that reckoning comes from gradual market correction or sudden structural failure, and whether the companies involved are simply too interconnected to fail independently or too leveraged to survive together. Let's begin with the fundamental numbers, because context determines meaning. American corporations collectively spend approximately $1.2 trillion annually on capital expenditures across every sector: energy infrastructure, manufacturing equipment, transportation networks, technology systems, everything. OpenAI has committed to spending roughly the same amount over 5 years, but concentrated entirely within computing infrastructure, a single company matching the capital intensity of the entire corporate economy. But that comparison understates the concentration. When we isolate just the technology companies involved in these agreements, the distortion becomes clearer. Over the last 12 months, Amazon, Broadcom, AMD, NVIDIA, Oracle, Microsoft, and CoreWeave combined spent approximately $225 billion on capital expenditures. These are among the largest corporations in existence. The deals OpenAI has signed with these same companies represent nearly 100% of their current spending levels. We're not talking about incremental growth. We're describing a fundamental restructuring of where capital flows within the technology sector. Consider what revenue growth would be required to justify these commitments. OpenAI's spending obligations escalate from roughly $6 billion in 2025 to approximately $295 billion by 2030. That trajectory requires the company to increase revenue by a factor of 85 within 5 years. To put that in perspective, there is currently no company on Earth generating $983 billion in annual revenue. Not one. The implication is straightforward. OpenAI would need to become not just successful, but historically unprecedented in scale to meet its own obligations under existing agreements. And we haven't yet addressed operating expenses. Capital commitments don't include electricity costs, which for the proposed data centers would rival small nations. They don't include maintenance, technical personnel, facility management, debt servicing, or any other operational requirement. The gross revenue figures we're discussing represent the floor, not the ceiling, of what would be necessary. This brings us to a particularly revealing moment. In late 2025, OpenAI's chief financial officer gave an interview where he discussed potential financing structures for these commitments. He specifically mentioned seeking support not just from private banks and institutional capital, but potentially from government guarantees, federal backing, the implication being that if OpenAI cannot fulfill these obligations, American taxpayers might ultimately absorb the shortfall. That's not a financing strategy. That's a contingency plan for systematic failure. But treating this as solely an OpenAI problem misses the larger architecture. Anthropic, the company behind Claude, raised $27 billion in funding and now carries a valuation of $183 billion. They've committed to purchasing $30 billion in computing capacity from Microsoft's Azure platform, with potentially another $14 billion from Amazon Web Services. Meta acquired Scale AI for $14.9 billion, announced $70 billion in data center construction, and committed over $1 billion to compensation packages for artificial intelligence researchers. Many of those researchers subsequently declined the offers, returned to previous positions, or launched competing ventures. The spending extends across dozens of companies, each making commitments that assume continued exponential growth. According to analysis from Bain & Company, the mathematics of these collective commitments require approximately $2 trillion in new revenue generation. That represents 7% of current United States GDP, not spread across the economy, concentrated within artificial intelligence services and infrastructure. Now we need to examine not just the scale of these commitments, but their structure, because the nature of these deals reveals something more troubling than simple overextension. These aren't arm's-length transactions between independent parties. They're circular arrangements where investments, revenue, and obligations flow between the same companies in patterns that obscure actual value creation. Microsoft invested over $13 billion in OpenAI's commercial division in exchange for equity and revenue-sharing rights. But the majority of that investment wasn't transferred as cash. It came as credits for Azure cloud services. Microsoft invests in OpenAI so that OpenAI will purchase Microsoft products. The investment creates its own customer base. But the circularity deepens. Because OpenAI uses Azure computing capacity, Microsoft must expand its data center infrastructure. To do that, Microsoft places massive orders with NVIDIA for graphics processing units required to meet OpenAI's needs. So Microsoft invests in OpenAI, OpenAI buys from Microsoft, Microsoft buys from NVIDIA. Each transaction creates revenue that appears on financial statements, but the actual cash moving between parties becomes difficult to trace. Then NVIDIA closes the loop. The company announced plans to invest up to $100 billion in OpenAI, with the understanding that OpenAI will spend those funds purchasing NVIDIA's processors. NVIDIA pays OpenAI to buy NVIDIA products. The investment becomes a purchase agreement disguised as equity funding, and OpenAI can use the remaining funds to continue purchasing services from Microsoft, which maintains Microsoft's ability to keep buying from NVIDIA, which enables NVIDIA to keep investing in OpenAI. The cycle perpetuates itself. Microsoft invests in OpenAI. OpenAI purchases from Microsoft. Microsoft purchases from NVIDIA. NVIDIA invests in OpenAI. OpenAI purchases from NVIDIA and Microsoft. Each transaction generates reportable revenue, creates accounting entries, and produces financial statements showing growth. But determining what portion represents actual economic value versus circular paper transactions becomes effectively impossible. There are dozens of these interconnected structures throughout the sector. And the fundamental problem is measurement. When one company's revenue is another company's expense, which is a third company's investment, tracking real cash flows becomes analytically intractable. The normal methods for valuing companies, for assessing financial health, for determining sustainability, all break down when the underlying transactions form closed loops. Add complexity instruments, conditional financing, equity kickers, and derivative structures, and even sophisticated financial analysis can't definitively separate legitimate business activity from artificial revenue creation. Which raises the critical question, how do you value these companies when you can't determine what's real? And if all these companies are financially interdependent, what happens when one fails to meet its obligations? Does the system absorb the shock, or do the circular dependencies create cascading failures? That brings us to the obvious comparison everyone is making. How similar is this to previous financial crises? Are we looking at a repeat of 2008? Or the dot-com collapse? The answer is, partially, but with critical differences that make simple historical parallels inadequate. The 2008 financial crisis eliminated nearly 9 million jobs and destroyed $11 trillion in household wealth. The trigger was subprime mortgages, which represented about 20% of all U.S. home loans. Approximately $2.2 trillion in total value. Defaults on those mortgages exceeded $500 billion, but the systemic losses reached over $10 trillion. How does $2 trillion in troubled assets generate $10 trillion in losses? Through securitization, leverage, and derivatives. Those mechanisms multiplied the market exposure to bad mortgages by roughly 15 times. The current AI infrastructure situation is structurally different in important ways. These commitments aren't being securitized into tradable instruments that spread risk globally. They're not being leveraged through exotic derivatives that multiply exposure across the financial system. And unlike many institutions in 2008, the major technology companies involved have substantial cash reserves and relatively low debt levels. If these commitments prove unsustainable, these companies have balance sheets capable of absorbing significant losses without triggering bankruptcy. The dot-com bubble offers a different set of parallels. That bubble inflated over years as investors became convinced the internet would transform everything. Communication, commerce, information access, all legitimate predictions that ultimately proved correct. From 1995 to March 2000, the Nasdaq Composite gained 572%. But when the Federal Reserve began raising interest rates in 1999, investors started demanding actual profitability. Most companies couldn't provide it. Panic spread. By October 2002, $5 trillion in market value had evaporated. At the peak, the Nasdaq 100 traded at a forward price-to-earnings ratio of 60, meaning investors paid $60 for every $1 of expected future earnings. Today, that ratio sits around 30, half the previous bubble valuation. And many of the failed dot-com companies actually had viable ideas. They just lacked sustainable business models at the time. The good companies survived. Amazon, Apple, eBay. The bad ones disappeared. Market corrections separated legitimate businesses from speculation. Moreover, most dot-com companies weren't profitable at all during the bubble. Today's major technology companies generate enormous profits. They have established revenue streams, proven business models, and strong cash generation. The financial foundations are fundamentally stronger. But here's where the current situation introduces unique risks. The AI infrastructure bubble doesn't have the securitization and derivative leverage that amplified 2008. It doesn't have the valuation extremes and profitless companies that characterize the dot-com era. What it has instead are trillions in interconnected corporate obligations, circular revenue patterns that obscure real cash flows, relatively high valuations despite lower PE ratios, and an economic environment where interest rates cannot remain suppressed indefinitely, and there's substantial variation in quality. Some of these companies have strong fundamentals, genuine cash flows, and sustainable business models. Others are built on circular transactions, questionable revenue, and assumptions about exponential growth that may not materialize. The challenge is determining which is which when the financial structures are deliberately opaque. As Charlie Munger observed, if you mix raisins with manure, you still have manure. There are excellent companies in this sector. Firms with real profitability, sustainable operations, and genuine value creation. But surrounding that quality are layers of circular corporate deals, artificial revenue generation, spending commitments that require OpenAI to become the largest company in human history to fulfill its obligations, and executives discussing federal guarantees to mitigate risk. Someone will argue the good fundamentals justify everything, but when the quality is mixed with systematic opacity, determining what you actually own becomes nearly impossible. Which brings us to the fundamental question: what happens when reality fails to meet these projections? If OpenAI cannot scale revenue 85-fold in 5 years, those obligations don't simply disappear. Contracts have consequences. Defaults trigger penalties. Failures cascade through interconnected systems. Microsoft's revenue from OpenAI informs their capital planning. NVIDIA's investments in OpenAI depend on purchase commitments. AMD's equity grants to OpenAI require corresponding hardware sales. Each company's plans depend on assumptions about other companies' performance. When those assumptions prove wrong, the failures propagate. The most dangerous phrase in finance is, "This time is different." But the equally dangerous phrase is, "This is exactly like last time." Because while patterns rhyme, circumstances evolve. What we're observing isn't a replay of 2008 or 2000. It's a new configuration of familiar problems: excessive leverage through corporate obligations instead of derivatives, circular revenue replacing straightforward speculation, and systematic opacity masking fundamental value. The question isn't whether artificial intelligence represents transformative technology. It almost certainly does. The question is whether the current financial architecture surrounding AI development is sustainable, or whether it's designed primarily to show growth on financial statements while deferring actual reckoning as long as possible. And that question won't be answered by opinions or predictions. It will be answered by mathematics, by revenue growth either meeting or failing to meet these obligations, by companies either fulfilling their commitments or restructuring them, by markets either absorbing these dynamics or forcing corrections. The data is accessible. The commitments are documented. The circular structures are visible to anyone willing to examine the details. What happens next depends on whether the underlying assumptions about AI adoption, revenue growth, and economic value prove correct, or whether we're watching the construction of the most elaborate corporate financing structure ever created, one that works perfectly until any single component fails, at which point the interconnections become liabilities rather than assets. The mathematics are clear. The commitments are binding. The circularity is documented. Whether this represents the foundation of a transformed global economy or the architecture of coordinated overextension will become apparent within the next several years. There's no need for panic, but there's also no justification for complacency. The system is what it is. The numbers don't require interpretation. And the question isn't whether you believe in the AI revolution. The question is whether you understand the difference between technological progress and financial sustainability. Because one can be entirely real, while the other remains entirely unsustainable. And right now, we're watching that distinction being tested at a scale never before attempted.